Hi, I'm Dean Brazier from the SEC Small Business Advocacy Team. Thank you for joining us today to hear from a panel of thought leaders, including Grace Rains from Arkansas Angel Alliance, Eli Velasquez from the Investors of Color Network, and Elizabeth Yin from Hustle Fund, on how savvy early stage investors build diversified portfolios. Without further ado, let's get today's session started.
Thank you, Dean, and welcome everyone to day 2 of the Small Business Forum. For those who joined us yesterday, we are thrilled that you are back with us today. And for those who missed day 1 of the SEC's 40th Small Business Forum, we heard from wonderful speakers on topics including how to raise your first dollars, how to leverage your networks and platforms to support others, and how we at the Commission should be thinking about inclusionary access to early stage capital. Yesterday, we heard opening remarks from Chair Gensler and Commissioner Peirce, and today I am pleased to welcome Alad Roisman for some welcoming remarks. I'll also add the disclaimer that the views expressed today by participants in the forum are those of the individuals and not the organizations they represent. Commissioner Roisman, I'll pass the unmute button over to you.
I am pleased to welcome you to day 2 of the 40th Annual SEC Small Business Forum. While we are all looking forward to the day we can hold such events in person again, I hope that this format enables more people to attend without the cost or hassle of travel to us here in Washington. Regardless of our location, I must still give my disclaimer, which is that my remarks reflect my views alone and not necessarily the views of the Commission or my fellow commissioners. The fact that this forum has got convened now for 4 decades speaks to the evergreen nature of small issuer and investor concerns. Although we at the SEC have made some strides towards increasing our awareness of and focus on this important group, not least of which has been selecting our first advocate for small business capital formation, Martha Legg-Miller, there is clearly still work to be done. As an SEC commissioner, my duty is to promote and further the SEC's mission, which includes facilitating capital formation. At an absolute minimum, this means that I must ensure that our rules do not unduly and unjustly prevent capital formation. I worry, however, that many of our existing rules do exactly that. At a recent meeting of the SEC's Small Business Capital Formation Advisory Committee, the committee members took up for the second time the concerns of underrepresented founders. The message that comes through loud and clear is that founders get funded by their networks, and regulatory barriers that prevent founders from obtaining capital from their existing networks may result in those ideas not getting off the ground. That is, if we are concerned, and I am, that the difference between a good idea getting funded or not getting funded is the difference between whether a person has friends who are wealthy or not, we need to look at how we can open up investment opportunities to more communities throughout our country. Capital raising is obviously of interest to founders and small business owners. But investment opportunity also affects would-be investors. For years, it has been clear that one of the greatest opportunities for wealth building has been in the private markets. Many non-public companies have been growing in value and have delayed going public, or have not gone public at all. When we look at underrepresented groups, we must also look at the networks of would-be investors and whether we are unjustly preventing many Americans from building the kind of wealth that establishes intergenerational stability and a firm footing in the middle and upper class. I also have a duty to protect investors, and I have no interest in tearing down valuable protections. I do, however, have a strong interest in finding ways to ensure our markets are not only deep, liquid, and transparent, but also inclusive in the opportunities they provide. This may mean expanding the definition of accredited investor, opening the way for the development of funds that would permit retail investors to invest alongside and on equal terms with institutional or accredited investors, or other structures we have not yet considered. I know many of you are in the trenches dealing with these questions of how to fund your businesses and how to reach more investors. My door, virtually for now, is open, and I welcome any insights you can provide. Thank you for being with us today. I hope we can work together to solve some of these evergreen problems, especially as small businesses recover from the difficulties of the last year.
Thank you very much, Commissioner Roisman. I appreciate those opening remarks, recognizing the importance of personal networks and looking at inclusive capital markets. I am pleased to be stepping away and getting out of the spotlight so that we can turn things over to our wonderful panelists who are joining us today. But before I do so, I want to give you a framework for how you can engage with us, because that is what makes the forum different than a webinar. A forum is an opportunity where we're engaging with one another. You're not just passively listening. So make sure that you're sharing your feedback in the polling questions that are live right now, because we want to learn a little bit more about you and the perspective that you bring. If you have questions that you would like to ask of our speakers, I want to encourage you to start adding those to the Q&A now and throughout the event so that we can have them queued up to ask them towards the end of the panel discussion. If you want to ask us a live question via video, you are welcome to chat your interest in doing so over to the team. I also want to thank you for your thoughtful advanced submission of policy priorities and recommendations submitted before the event started. If you think of additional policy suggestions relevant to today's topic, I encourage you to share those with our team in the chat so that we can add them. After the panel and the Q&A, you're going to get a chance to vote to prioritize the recommendations that the audience members have submitted and send those over in a report to Congress and the Commission. The poll is currently visible with recommendations right now for reference only, and it will open up for voting once we've had a chance to add in any tweaks or edits that have come in from you. We love learning about you. We love having you here today, and I appreciate you spending time with us. It is now my pleasure to turn things over to my colleague and friend, John Moses, from the SEC's Office of Investor Education and Advocacy to lead our panel on doing your diligence, how savvy early stage investors build diversified portfolios. John, take it away for us.
Thank you so much, Martha. It's an honor to be here with you, and especially with our panelists and everybody joining from around the country today. So as Martha said, I am with the Office of Investor Education and Advocacy, and we're thrilled to fulfill part of the SEC's mission around protecting investors by doing outreach and education around topics that are really important to investing and building wealth over the long term. Please check out our website, investor.gov. Investor.gov has information on foundational principles like diversification and minimizing fees, and also information on updated topics that you might be hearing about in the news. Also, if you have a community organization, a student group, or a faith group, for example, and you'd like us to connect with you to talk about investing, please send us a note at outreach@sec.gov. So investor.gov and outreach@sec.gov. So that was my pitch, everybody. We're going to be hearing from Elizabeth and others who have heard many thousands of pitches. But that's my pitch about OIEA. But today we're going to be talking about successfully investing in early stage companies. As we all know, unlike mature businesses with established track records and income, many early stage businesses are pre-revenue, and they're building products or services that may or may not be successful. We hear in the news a lot about success stories of startups. We know that savvy early stage investors will make some successful investments and some investments that don't turn out well. And so these investors have to balance the risk of loss in any single investment across what is hopefully a diversified portfolio. Today, we're going to talk with 3 investors about how they conduct diligence on early stage companies to balance the risks and potential rewards of investing in startups. Another quick plug for audience questions. Around 1:45 Eastern, we'll be moving to audience questions. So please put your questions in the chat, or let us know if you want to ask one live. You can also send an email to eventsupport@secsmallbusinessforum.com. And so now let's get to the panelists. First, I'd like to introduce Grace Rains. She is Executive Director of the Archangel Alliance, and Grace leads the initiatives focused on new member recruitment, deal vetting, and due diligence in this Arkansas-based group. The organization, I think last year, Grace expanded its scope and rebranded from Central Arkansas Angel Network to Archangel Alliance. Get it? It took me a second. And she's also serving entrepreneurs throughout the state through her work as Director of Operations at Conductor, which supports entrepreneurs with education, networking, and other work, including specific outreach to rural entrepreneurs in 11 Arkansas counties. So Grace, one of the questions I want to ask you and each of our panelists as we start is, what is your typical check size at Archangel or in your other work through Conductor? What do you typically see?
That's a great question. So, as I mentioned before we even got started, we're a pretty young angel network. We have about 3 portfolio companies, working on a 4th right now. So from an average perspective, we don't have a good set of data, but so far we've seen anything between $5,000 and $150,000 from our investors.
Excellent. Thanks so much for sharing. I know people like to hear dollars. Next, I'd like to introduce Eli Velasquez. He's the co-founder and managing director at Investors of Color Network. He's also a board member of the Angel Capital Association, which I think he's called his unpaid full-time job. I'm sure you do great work and service for angel investors throughout the country through that, Eli. Through Investors of Color Network, he's focused on introducing more minority accredited investors to startup investing and helping connect them with entrepreneurs to back, including underrepresented entrepreneurs. One of his influential experiences he shared that I really found compelling was his work on a investing team in a border community that had a high concentration of Latinx population, but very few entrepreneurs were actually backed. And I know that was part of your reasoning for launching your group, Investors of Color. So we'd love to hear more about that or other insights, and how you're using your connections and your network to help change that. In your network, Eli, what's a typical check size?
Yeah, so John, thanks for having us. So our membership really encompasses everything from the individual angel all the way to late stage VC. And so we're looking at deals that start as early as an individual who can write a $5,000 check, all the way to maybe later stage venture funds and family offices that are looking at deals in the $1 million plus. So we cover a pretty wide gamut of the kind of deals that we look at and can invest in.
Great. That is a wide range, and I'm sure will be of interest to a lot of listeners. Finally, I'd like to introduce Elizabeth Yin. She is co-founder and general partner at Hustle Fund, which besides being a great name, also backs a huge number of early stage startups. She's previous startup founder and CEO herself, and has supported entrepreneurs through 500 startups. I mentioned during my pitch for investor.gov, there it is again, I think you're supposed to weave it in whenever you can, that she has heard over 20,000 startup pitches. That is amazing and maybe just a little bit scary. But through all of these pitches, when you back a company, Elizabeth, what do you typically see through Hustle Fund or the affiliated angel group in terms of check size?
Yeah, so with Hustle Fund, we are investing $25,000 checks. At Hustle Fund, we've been around for 3 years and we have backed over 260 software companies. But that being said, I think most people are not excited about raising only 25K these days. So we do actually help companies raise a lot more money with co-investors, whether they're angels or other VCs.
Great, that is fascinating, and what a huge number of companies to be connected to. So diving into the questions now, Elizabeth, maybe we could stick with you and talk a little bit more about the Hustle Fund. On your website, you say that you invest in hilariously early startups. So what is so funny about these startups? So what's hilariously early for you, and why do you invest in such early companies?
Yeah, well, I mean, I think honestly, the hardest part is just getting started. Once you're going and you have momentum, of course, a lot of investors are interested. It's, you've got your traction and it's kind of clear what trajectory you're on. But in those early days when you're just getting off the ground and you don't have any customers, you don't have any revenue, you need a lot of investors to have belief. And that's when it's really hard to fundraise at what I would call pre-seed. That's kind of the nomenclature these days. And so we felt like, well, there's a real opportunity to help a lot of startups just kind of get off the ground. And if you don't have like a rich uncle or something to help you with a friends or family round, then you hear stories about founders taking out a lot of debt on their credit cards or, working 20 jobs or whatever. And so that's kind of the stage where we play. It's past an idea stage. You've kind of gotten a little bit of validation qualitatively from potential customers, but you don't necessarily have revenue. And that's what we mean by that.
Great, thanks for sharing. Again, I think that context combined with some of the information you each graciously provided around what you're seeing on typical check sizes is practical and useful. So thank you. Eli, you have, as I mentioned in the intro, significant experience investing in underrepresented founders. So whether that's through your own investment group or with Angel Capital Association, there's been some work, and I know you've maybe even just recently, if I remember correctly, been working to sort of refine these processes around doing diligence to develop a playbook of sorts. What kind of characteristics or considerations are you seeing or that you think would be useful when finding and deciding to back or not underrepresented entrepreneurs?
Yeah, I love that question, John, because it helps us kind of rethink of the investor-entrepreneur relationship, right? For so long, it's always been this notion of the entrepreneur comes with hat in hand to the investor and kind of makes a plea and a pitch. Maybe he says, "Oh, great and mighty investor, please hand me some coins so that I can go build my business." But what we're really seeing now is really savvy, sophisticated, investors. Elizabeth's model is, I love that model because it's nimble, right? And so investors that are interested in getting into the space of diversifying their portfolio with founders of color has to be a very, very active approach, and you have to go to them as well as them trying to find you. So one of the things I say is, if you're out there looking for founders of color, put on your LinkedIn that you're looking for founders of color, right? Go actively seek them out, send them messages, reach out to them. There's colleagues in our network that have literally been outreached by some posts that they put on Twitter, right? And so those investors found them and they actively went out and sought them out. Now, when you do engage with them, I think one of the first starting points is definitely understanding what that founder story is. Before understanding what the whole business model is, the market, the problem, just listen to how they got to where they got to and the challenges that they had to overcome to get to your doorstep, right? When you start to understand the story of the founder of color or underrepresented individual, you start to see that common ground between you and the investor that so many investors say, I invest in the team, right? That's really trying to understand what that personality fit really is. And so you're trying to understand what that individual's shared experience might be with yours. Even if you think it might be completely different, you might find something there that links you up to them. So I would say those are two key practical points to undertake from both the investor side, and the founder side. Don't be afraid to tell your story, as you're starting out those early dialogues with the investors as well.
Great, thanks for sharing that, Eli. Grace, so you're, I think, maybe the only or one of a very few active angel groups in Arkansas, is that right?
Yes, it is.
So what are you targeting through your angel group? What types of opportunities are you targeting, and what are you sort of seeing happen in the Arkansas entrepreneurial and early stage investment space?
So we are mainly focusing on those pre-seed companies that Elizabeth mentioned, seed, and then some Series A deals. So pretty early stage ventures, some pre-revenue, some post-revenue. We're seeing a trend of, more and more capital going to later stage deals. We're focused on some of those earlier stage deals that feed the pipeline to those later stage companies. All of our companies that we look at are Arkansas based. So, only about 10% of venture capital goes to Heartland companies. And so we're trying to change that. A lot of the investors are outside of the Heartland. A lot of VC companies are outside of the Heartland. And that's why that capital is going to those places, is because, investors invest about 100-mile radius around where they're at. And so us growing investors in Arkansas is important, so that we can make sure that we're funding Arkansas-based deals. It's important to us to grow that capital locally. And then from a vertical perspective, we don't really give a preference to verticals, but in Arkansas we see a lot of supply chain especially up in the Northwest Arkansas area, because we're with Tyson up there, Walmart, and then we see some fintech and healthcare here in the Central Arkansas area with FIS and a little bit of data from an Axiom standpoint. And then of course agri-tech, because we're in the South and we see a lot of agriculture down here. But those are the main companies we're looking at. But like I said, we don't give a preference to vertical. That's just what we tend to see when we're looking at Arkansas-based companies.
That's interesting. So you gave some data about where VC and early stage dollars are flowing. There's some for the audience. There's some great information in the SEC Small Business Office's annual report. So some data on that about where the money's coming from, where it's flowing, and some great graphics as well. So I encourage you to check that out. A follow-up actually for you, Grace. So I think you recently hosted a conference with other investors, and one of the things that you were focused on is how to locate and vet entrepreneurs. Did you have any takeaways from from that gathering that you can share with the audience today?
Yeah, so one of the main focuses of our group, since we're one of the only groups in Arkansas doing angel investment, so a lot of our investors have participated in funds before, so done a little angel investing, but some are completely new to the angel investing game. So, we want to provide a lot of educational opportunities for our investors, just to strengthen and make them more comfortable with investment. So we did host a due diligence session with actually Barbara Clark from Astia Angels. She did the session with us. And so, my probably 3 takeaways that I came back with, the first thing she said was, the devil's in the details. So she really gets into the details of the company she's looking at, everything from governance documents, to, there's specifically where, who is holding their IP and things like that you might assume are all kind of taken care of, but once you kind of peel behind the surface might not completely be as shored up as you would like them to be. So that was one of our key takeaways. And then also just building a diverse due diligence team. So just making sure from our membership that we have the right people at the table. And so, we recently brought on an IP attorney to actually be on our board. And so she's able to give us a lot of insight there. And we saw that as a gap. We didn't have a lot of people in our group. And so, identifying those gaps and making sure we're bringing the right people in so that they can weigh in on the conversation as we're looking at deals. And then also, she said, sometimes it's more important the way an entrepreneur answers a question than the answer itself. So, their confidence level, if they have hesitations, sometimes it's less about what they're saying and how they're saying it. And so I thought that was just so insightful, because it's so true. As we look at these investors, a lot of times, we're asking questions just to kind of hear their confidence level and how quickly they're able to answer or not answer if they stumble. So
Great.
Those are our key takeaways.
Thank you. Again, a lot of actionable insights there. Thanks for sharing. Eli, Grace was just talking about gaps on their due diligence capability that they were looking to fill in Archangel Alliance. You've thought a lot about gaps between where the need is, where the dollars are, both in terms of regions. Feel free to share some stories about Texas, and then also in terms of demographics nationally. Where do you see the biggest gaps in terms of connecting entrepreneurs and investors from your perspective at Investors of Color Network?
Oh gosh, that's a laundry list, John. Those are the issues that are literally going to take a generation or more to solve. But I would say that there's a couple of key ones. So, and I'll approach it from both the investor side and the entrepreneur side. On the investor side, we're seeing just this groundswell of new fund managers of color, angel investors of color, looking specifically to find those founders. In 2020 alone, there were 9 that we identified within the first half of the year. And some started literally on the day that we locked down, right? And so you can imagine the challenges that those investors have had to face over the course of the last year. By the end of the year, there was over 25 that we had identified, despite a pandemic, right? So there's a groundswell of new investors coming online. And so they're also learning and trying to navigate their pathway, trying to understand what their ecosystem is, and also start, fundraising at the same time. So there's a lot of activity in the Investors of Color network that still is, we're looking to figure out how we start to coalesce the community and organize it. So that can lead to a lot of confusion for founders of color as well, right? And so as they're trying to navigate their way through, is they're trying to figure out, is this the right network? Have they identified a thesis? And so one of the key challenges, and one of the things I really encourage both investors and entrepreneurs to do, is to really hone in on their investment thesis. What is the specific activities that you're going to be focused on, but not just an investment thesis, an impact thesis as well. Why are you investing in this particular space or vertical or individual, and what is the impact that you hope to accomplish? So for us, we start pretty broad. We want business models that positively impact the education, the health, wealth, and social mobility of communities of color, right? Anywhere from seed to Series C type of deals. So it starts to narrow down the focus, and then we identify verticals. And as entrepreneurs are out actively doing their research online, they can start figuring out what that thesis alignment might be, and also the value alignment. Is this the kind of investor that I ultimately want to partner with for the next 3, 5, or 10 years? Do they share the same values that I share as well? So I like to really push that investors define a thesis, and entrepreneurs look for investors whose thesis aligns with their business model, and see if you can start building those linkages there. That'll help make the research a little bit more efficient.
That sounds like a great way to ground yourself when there's so many opportunities, and increasingly people are looking nationally and even internationally, especially I know in Elizabeth's case at Hustle Fund. Elizabeth, you have this very wide funnel. We talked about that at the beginning. It's just a very large number of companies that you've backed, and so you've seen a lot of different things in terms of entrepreneurs and what you've seen working and not working. Also on your website though, you have these great things, right? So you talked about hilariously early. Another item that stood out to me on Hustle Fund's core principles list is blunt feedback. So that can be jarring. Maybe it can also sometimes be hilarious, but we'll try to stay positive. It can be jarring, but really potentially quite productive for entrepreneurs, even when you decline to invest. In fact, and maybe we'll have time to get to this, I saw you giving some very blunt feedback on network building on Twitter in the last day or two. So if we don't get to it, everybody should check out Elizabeth's Twitter handle to review that. But could you give us some examples or common themes in the blunt feedback that you've shared with entrepreneurs as a result of the diligence process at Hustle Fund?
Sure. Thanks, John. I think it's very helpful actually to kind of understand a bit of context. I previously was an entrepreneur, and I've pitched so many VCs myself for my startup. And often what would happen is these VCs would just totally ghost on you, or maybe they would say, this is not for me, which is, fine, but it's completely not helpful. And so I felt like, well, now that I'm on the other side of the table, even if I cannot get involved in a company, at least I want sort of the entrepreneur to understand where I'm coming from. They may or may not agree, and that's fine. And B, also get sort of a piece of feedback, or at least another perspective, whether it's useful or not. And so one of the things that I try to leave with every founder, whether we get involved or not, is some of that feedback. And often it's very tactical around customer acquisition. I've been an entrepreneur before. My mindset is entirely about customer acquisition. When you're investing in software businesses, frankly speaking, there's not a lot of IP these days, and it's completely competitive. So how are you going to get a foothold in getting traction? And so I think a lot about, okay, what is the cost to acquire a customer in all of these different channels? Is it completely crowded? And that's the kind of feedback I'll give founders, is like, your go-to-market, it seems like actually, you're entering this foray of SEO, but like there are 20 other companies that do exactly what you do. How are you going to differentiate? So things like that are the things that I think about, and the things that I kind of relay to founders, whether they agree or not. And I always frame it as, this is just my 2 cents, my perspective, for whatever it's worth.
Thanks for sharing that. So I'm going to call a little bit of an audible here. And Grace or Eli, did you have a follow-up for Elizabeth? She sees this huge funnel of companies and all of these connections. Anything around diligence or feedback that you'd want to share or ask of Elizabeth?
Yeah, one of the things that, and I love what you said, Elizabeth, I agree 100%, is one of the things I also like to leave with is don't tell the entrepreneur you're too early. Tell them specifically why they're too early for you. And then two, the other thing I like to do is say, here's another way that we could help. So maybe here's an introduction, or here's something else. So when we do our deliberations with our investors, we say, are you interested? Yes or no. If you're not interested, that's okay, but can you help in other ways? And what generally happens is investors want to help, right? They naturally want to say, let me see how they've been through that process of working with entrepreneurs before. Generally, what that means is they might have the ability to open their network. And so that helps maybe lead in some different directions. We had a case, the investor was not interested, but they actually helped the founder get a customer. I was like, that's just as good, man. Like that helps you move that business forward. So don't just turn the door, don't close the door on the entrepreneur. Leave them with something, so that because they shared something of value with you, which is their business idea. So you leave something of value with them, even if it's not just money. So that's my 2 cents on
that. Great, Grace. Any questions or follow-ups on these points around? So
no, I think I completely agree with what Elizabeth and Eli both said. I mean, I think that helping them, there's a lot of ways you can help a founder. Because we're an angel network and our investors make individual investment decisions, we have had some legal recommendations that we don't provide direct feedback as to why we didn't choose a company, only because we're an aggregated group decision, not a fund making a decision necessarily with an investor committee. But there's a lot of ways that we can support and provide feedback to entrepreneurs. And a lot of time that's referring them back out into the ESO community or the entrepreneur support organization community and saying, you could work with this organization to help you with X, or, here's a resource that could directly help you, or let me help you make a strategic connection here. Even though we're not providing dollars, how else can we support? So that's a great way that you can kind of soft no, but still support the entrepreneur.
This is one of my favorite insights from this conversation so far. Thanks for these specifics, and it does lead to something that I was referring to before, Elizabeth, about your recommendations around really sort of playing the long game when it comes to your network, and maybe there's a bit of at least a thematic tie-in to diligence when we're talking about very early stage companies that are potentially pre-revenue, or likely, it sounds like in many of these cases, pre-revenue. A lot of it is about the team and how they handle difficult situations and their own relationships with their network. Can you sort of speak to the comments you've made on that briefly in terms of building your network?
Sure. So I think, there are many different angles we can go with this, but, one that comes to mind is, I think often a lot of investors in the ecosystem feel like, oh, well, if I give people blunt feedback, then maybe they won't come back to me or whatever. But I've actually found the opposite, where there have been often times where I have mentioned to the founder, hey, I really am impressed by you. I don't have conviction around the customer acquisition or go to market of whatever it is they're doing. And then they come back, they're like, you're right. I ended up doing more experiments around these things and didn't quite work. And so I ended up pivoting into this other idea or this other angle or whatever. And I think, for Hustle Fund, we counted something like 10 times out of the 260 plus companies we backed, they were because of some back and forth with the founder, where we initially said no and gave them specific reasons why it was a no. Founder took that feedback, went and did something different, came back and said, hey, I want to get your thoughts around this. So it's I think a lot of the times people think, oh, it's sort of a one and done transaction, but that's not the case at all. Like, this is just one example of sometimes there's a bit of back and forth, and it may be on this venture, or maybe on a subsequent venture, or maybe years later, but that I think is really the long-term game that I'm talking about, where you build a relationship with people and it may go somewhere, like, at some point.
Great. Thanks, Elizabeth. So let's talk a little bit about liquidity. So we often hear that companies are more likely to succeed in getting larger, later stage investments than early stage. And something we haven't talked about today, but happy to hear any comments on, is sort of the sort of ever changing range of what is a seed or pre-seed or Series A round. But there's lots of reasons that people might be more interested in larger, later stage rounds. But one might be liquidity, and at least the idea that that could happen a little bit sooner. So Grace, when you're in your network, whether it's through the two main organizations that you work with, or just what you've discovered through your relationships with investors and entrepreneurs, what is the role of time horizon and liquidity and decision making for early stage investors? Is that a driving force, or how do people think about that when trying to determine what investment to make?
That's a great question, John. I think it's a big enigma in angel investing. When you start talking about that exit strategy, what is that exit? And especially when you look at those really early stage companies, a lot of times the way that they answer that question, and looking at the way they answer that question specifically, is a lot more important than necessarily what they have to say. But angel investing is high risk, high reward. You mentioned it earlier. You're talking generally about a pretty illiquid asset class, and so I don't think anybody that's in the angel investing realm is going to lie to you about high risk, illiquid. I mean, nobody's trying to hide that that's the kind of asset class we're talking about, but it's a part of the whole portfolio, like what you mentioned at the beginning. It's a part of an overall investing strategy. It's an asset class that you bring into your portfolio. It may take years for you to see an exit on an investment you make, and you might not see an exit at all. You may not see any dollars come back. But the key there is building that diversified portfolio of companies across verticals, across stages, to mitigate that risk. And then, understanding on the front end that it's a long play, so you're looking at, 1, maybe 2x, 5x, 10x, 20x return to make up for some of those ones that maybe aren't going to make as much money. And so, putting together that investment portfolio is kind of a key to being a successful angel investor. And that's, a hard nut to crack. And we've done a lot of education with our investors around what that looks like, and how do you diversify your portfolio? But that's why you see such a focus from angel investors on that exit strategy. So, a lot of companies that we look at, especially in pre-seed, seed, IPO is not a viable exit strategy for those companies. That's not what we want to hear. We want to talk about who are your potential acquirers? What is the relationship there? Do you have a relationship? Even better, are those potential acquirers on your cap table? Have they invested in you? Do they have some dollars in play that they want to see you succeed? Could they see you as a potential acquisition someday? And so, and if not, how do they plan on, engaging those potential acquirers to either, get them in as a strategic partner, or just started having those conversations and building the relationship? So, in order to mitigate kind of that liquidity issue, we, try and talk early about what is that exit strategy, what does that look like, and what is the founder's idea there too, because not all founders are exit focused, and it's important to see, do they see this as a long-term company for them, or is it an exit play for them? And that can help you understand too how long they see this investment, taking.
That's a great actionable question there, right? So if you think that a given potential acquirer is out there, are they investing, and are they on your cap table? Eli and Elizabeth, what about you? I mean, you're looking at possibly a few more deals, but Elizabeth, all of yours, I think you mentioned, are in the software space. How do you think about building a portfolio and eventual liquidity when you're dealing with such early stage companies?
Yeah, it's funny because I would almost say almost the exact opposite of what Grace mentioned for software, and here's why. I think one of the key things about the software VC market is that there is a lot of liquidity in the secondary markets these days. So even though it's taking companies longer to go IPO, and when they do go IPO, it's at sort of outrageous market caps these days. What a lot of people don't necessarily see is even as early as the Series A, investors can often get out because there's just so many more investors interested in the private markets these days. For us, actually, though, from our portfolio construction, we really like the high risk, high return, and that's why we also have a large portfolio to kind of, as Grace mentioned, diversify, and that's something that I completely agree with her on, and it's really important for an early stage investor. If you end up getting like an Uber in your portfolio, you put 5K into it, and if you had held on to the IPO, that'd be worth 25 million, right? And so you want to grab onto things that will have product market fit, and if they do, then you just ride it out until the end, is my general philosophy. But there are the secondary markets if you need liquidity earlier, and certainly for angels that may be a consideration. And so that's one of the things that I really love these days. Just there are a lot more options to get out for pretty much anybody, whether you're an angel or
Great, thank you. Eli, any thoughts on this, on the portfolio, building a portfolio and liquidity?
Yeah, this is an area that I hope we see a paradigm shift, and we're starting to see trends in this area where, for many founders of color, and maybe because of cultural reasons, we don't want to exit. We want to hold on to the company. We want to build a legacy business that we pass on to our children and our families, right? And so one of the issues here is, how can investors begin to think of liquidity in a different way, right? And this goes back down to the thesis is, where do you want to and how do you want to get your money out, and how do you want to get your money back? Because if the types of companies and the type of portfolio that you're building is not leading to exits, and there's no comps in that space, then what are the alternatives? Well, the alternatives are alternative investment instruments, right? So how do we set up a structured exit where once you raise the next capital, you then get your money back and then some? Do you do a revenue-based financing option? Do you do dividend returns? Do you do some form of royalty or license where you then say, look, I want to ride with the company for a certain period of time and then let you loose and let you ride the next way that you want to go, and I get my liquidity out of that investment opportunity. So I think one of the key elements of where we're going to be seeing new trends is angel investors, venture investors have to start broadening the scope of what an exit looks like, right? We're always focused on the IPO and we're focused on the acquisition. But as we see more businesses of color coming in the space, we have to have those cultural considerations. So one of the key elements is cultural intelligence in investing. Understand what the mechanisms of those kind of founders and the kind of businesses that they're building and what the liquidity event means for you has to be some sort of give and play and ebb and flow over the course of the next several years. So I'm really anxious to see how that's going to evolve in time, so that's something for investors and entrepreneurs to also be on the lookout for.
That, Eli, sounds like a book or at least a long article. Really important topic, and so many ways that might play out, including on the eventual future investing side, right? So Elizabeth has said she's an exited startup CEO and founder who's now an investor, right? And so we're talking about this in terms of liquidity for the investors, but also the entrepreneur backing future entrepreneurs is an element there as well, and bringing in diverse perspectives and diverse goals that might be tightly tied to different communities in the U.S. is important and fascinating. And thanks for raising that topic that way. So we're just about to get to questions here in a minute or two. So again, if you have something you'd like to share, send an email or put a question in the chat, and then Martha's going to take us through asking those questions of our great panelists. Maybe we can get towards that with something really positive. So I will ask each of you to think of an upside surprise. So maybe a deal that you either invested in or wished you had. You don't have to name the company if that's not appropriate, but a time where you did some diligence and you really underestimated what was possible. Could be one of your deals or something you've seen. So maybe I'll just put that out to the three of you. Can any of you think of an upside surprise where you did your diligence and you just got it wrong and it ended up wildly outperforming your expectations? Have you seen that, Elizabeth?
Many times. It's hard to think of just one. But I think, I'll give you an example of a company that we did invest in. The company's called Majuri, and it's a jewelry company, personalized jewelry company. And actually, a lot of investors turned them down initially, even after they had traction, even after they were selling, because just nothing really about the business kind of fit the stereotypical mold of a Silicon Valley company. Actually, founders from Canada, solo female founder, minority, and jewelry business, which is, kind of considered to be, quote, a woman's business. So I think a lot of investors felt like this cannot become that big, but as it turns out, jewelry is a big business, and so she really struggled. She couldn't raise very much money at all, and if actually it worked out well for her because she couldn't raise money. She got to keep more of the business, and she got to actually really high stages, and NEA, which is a pretty famous VC firm, ended up, leading this large round, in the last couple of years. They're doing incredibly well. This is what we call, I think, a unicorn business in Silicon Valley, like, billion-dollar valuation or thereabouts. And she has more upside ahead of her. So I think good for her. Everyone underestimated her. And, I feel so fortunate that she let us join.
That's great, and I think I've seen them. What about you, Grace? Have you seen anything that in your network where maybe people didn't quite understand the business, and especially in Arkansas, maybe there's not as much pattern matching, right? Because we don't have as many firms in some of the sectors that you mentioned earlier. Are there any examples of startups that did much better than your diligence would have suggested?
We actually had a company that we recently looked at. It was a founder, was a veteran and a minority. They were a medical device company, and medical device companies can be tough. A lot of times they stay pre-revenue for a lot longer than you want them to because they're just tied up in FDA regulations and things like that. The IP can be tough to get through. They require a lot of capital to get them there. And so, initially, it's not a positive response from a medical device company. So we looked at them, and actually once we dug a little bit deeper, the team was great. They were well poised for success. They had some really great strategic partnerships in place that were fantastic. The IP was all where we wanted it to be, and they'd gotten a lot of traction here recently, and actually gotten some really positive news around that as we were going through due diligence. And so our group is actually going to make a pretty significant investment in them now. Because of that. And so that was an exciting one that I really didn't see on the front end going anywhere, and then ended up turn out to be one of the most interesting things that we've seen this year so far. So that's exciting.
Thanks. That's a great example of why this space is so important, for investors, for entrepreneurs, maybe for the economy and country overall. Who knows what that firm will be able to do eventually with this backing. Eli, I'd love to hear an example from you, but maybe, especially as we run up right on time here to go to audience Q&A, can you discuss another underrepresented entrepreneur that presented a challenge in terms of getting to the investment and you ended up getting there and making the investment?
Yeah, so one of our great success stories is Marcus Bullock with Flickshop. He shares his story openly, right? He was previously incarcerated when he was a teenager, and later he served his time, right? And he went on to form a company called Flickshop, which enables families to send photos and messages in postcard form to incarcerated family members. And so when we met him, he was pretty much just tired of the whole, ringer that he was being put through with, so much criticism and trying to find the right investor. And so we said, look, man, we're not here to waste your time. We want to get down to the business side of it. We understand your story. That's in the past. This is going to help, millions of family members. So let's get to it, right? And so as we started getting into the diligence, this guy had his deal room, squeaky clean, because he had been put through the ringer, right? And so by this point, we said, Marcus, this thing, I've never seen anything as good as this, right? And he says, you can look under every rock, you won't find a thing, right? And so we were able to really make that process much more efficient. He secured investment from somebody in our network. He's gone on to do some great things. Look him up, Flickshop. He recently signed a contract with Boeing, or a partnership with the Boeing company, as part of their corporate social responsibility. But it's one of those things where it goes back to what I said earlier. You have to understand the story of the founder to figure out where that alignment is going to be for you as an investor to determine where you can add the most value beyond just the money. And so definitely look up his story. It's really inspiring. It's one that we love to share with our network as well.
Thank you, Eli, and thank you, Elizabeth and Grace. Really, really interesting, and appreciate you so openly sharing your stories and those of your fellow investors and the entrepreneurs that you're backing. So thanks for answering my questions. Now I'd like to turn it back over to Martha Miller to help us connect with audience questions that have come up during our chat. Thanks again.
Happy to do so. Thank you, John and Eli, Elizabeth, and Grace. I have loved the discussion so far. We have some questions that have come in from the audience. I'm actually going to take the first one because it's a wonderful opportunity to plug a resource that just went live from our office today. We got some questions on educational resources that investors or entrepreneurs could use. John, I know you're very familiar with investor.gov. We always point investors towards that. But if you are curious about some of the lingo that was used today by our speakers, we have a cutting through the jargon glossary that is available on our website. The link is being chatted in by our team members, but it is sec.gov/OASB, which is our office's lovely acronym. But that helps break down in plain language what some of the lingo is that's used. So that was the first question. I'm taking that one for the team, and I'll open up the first question for one of you. Eli, I'm going to point this one to you. Looking at the opening poll from our audience when asked about the number one source of investment opportunities, you all flagged network referrals. That's directly from our audience today. We got a question from Faith in New York about the role of finders or people who help bridge personal networks. Curious if you have used finders or any experience with people that help connect sophisticated investors like yourself with potential investment opportunities that are outside of your personal network.
I love that question. And so one of the fundamental values that we share is do the founder no harm. Or do the startup no harm. And so when we're looking at, the role of finders is we do want to understand specifically what is that relationship that you have with the founder, and how was that set up, to begin with, and is there something again additional to just that building of personal relationships or network relationships. So in the past, we have not had good experiences with finders. And so we tend to kind of have a little bit of a gut reaction initially when we hear that there's a finder that's in between that relationship. So that it causes us a little bit of pause, and it adds maybe an added layer of due diligence. We also understand the finder has to, walk that balance of a potential broker dealer. And so that's just an added layer of work that's on us. If we can avoid that, it's probably going to make the process a little bit more efficient. If we can find a warm referral or a warm introduction from somebody that's already in our network, this is where that hustle has to come from both sides of the table. And so, if you're looking to work with finders, do your due diligence as well to understand what's that relationship looking like, how long is that engagement going to be for, get under the hood of understanding what that really means for you, because that's yet another individual that is coming in between you and the founder or the investor. And so please take a look at that very carefully.
Absolutely. And I think that's great advice, Eli, because it is not always clear what the role is of a finder and whether or not they're acting as a broker dealer or they are doing something that's less than that. And the last thing that you need is somebody who is in the middle of your deal that might trigger some sort of a rescissionary right or something that could be potentially even predatory on your company. So great advice for companies. We also got a question from Nelson. I'm actually going to answer this one because this is what do you do if you believe you might have been the victim of a scheme or a fraud? And I want to make sure that everyone knows that you should go to sec.gov and you'll see a box to submit a tip or file a complaint, because I think, as each of our panelists can say, if it's something that sounds too good to be true, it probably is. So make sure if there is something, and particularly if it's something that's particularly egregious, I encourage you to reach out to us and share it so that we can work to investigate that on your behalf. Our second question for you, I want to send over to you, Grace. Ken from Vermont asked a question about the participation of non-accredited investors in investment opportunities. And I know that this is something that matters a lot to you, being from Arkansas, where there are fewer accredited investors than you might see in other areas of the country. Talk to me about the considerations that you have and that you look at when there are companies with an opportunity to take investments from non-accredited investors, or there are non-accredited investors who are interested in participating, but the company says, you know what, this one is limited to just accredited investors because of the offering exemption we're using.
Absolutely. And Martha, we've had some conversations around this. So you know some of my feelings on non-accredited investors and accredited investor standards. You always have to follow security law. So I would say that's the number one thing there. But, there are some opportunities for, if founders so choose, to take on non-accredited investors, and there's some way to do that by also mitigating that risk. So there's some risk in taking on non-accredited investors for the founders, and that can also be limiting for them later on as they continue to raise. And so some of the ways you can do that, there's a few platforms out there that will allow you to take equity in a company as a non-accredited investor and allow founders to take on investment from non-accredited investors and also give an equity stake. And so, Republic is a platform that you can use to do that. WeFunder is another platform. And so, I would say if you're interested in investing in some companies and dipping your toe in the water, those are some great ways to do that as a non-accredited investor. And to see some of these terms that are used, make sure you're diversifying your portfolio like any accredited investor would do. And then, keep in mind this is a high risk investment. And so it's part of an overall portfolio. So that's going to be my stipulations there. But there's some platforms out there too that the founders can also utilize to raise capital from a not accredited investor standpoint. So
I'll ask a follow-up question. And Elizabeth, Eli, I'd love your thoughts on this from a different perspective. We've got a pathway, and the data shows that we have an opportunity where non-accredited investors can participate. You can have a few of them under 30, 35 or under in your deal under our Rule 506B, which we try to not speak in regulatory jargon, but here we are at an SEC event, so we're doing it anyways. How often do you see transactions where there actually are non-accredited investors? The data that we see shows that it's very few, around 5, maybe 6% of deals actually have non-accredited investors participating. Curious if you ever come across deals where you see non-accredited investors on the cap table who have come through an offering exemption like that.
Yeah, I think at least for me, it's a really small percentage. And as Grace mentioned, largely through these sites such as Republic, where we invest alongside. But I think there are a couple of reasons for it. Everyone has kind of been scared up the wazoo to not take non-accredited investors. And so I think many founders feel like, oh, it's just too much risk. I don't want to cause extra issues or logistical challenges. And I think that's probably where that stems from. So I think, my plug to the SEC would be, the more that we can do to make that easier. And, obviously there are guardrails that need to happen. I think actually there would be that demand from non-accredited investors to be able to invest alongside VCs. Because, I think frankly speaking, a lot of those, some of the best deals in VCs, they don't actually necessarily end up going to those platforms, at least today, most of the time.
Yep. Yeah. And that is something that we hear about often, the opportunity to have more of a syndicate model where you have the ability to participate on parity with the terms that really sophisticated venture capitalists are getting, or sophisticated angel investors, not something where you're out having to fend for yourself and get in on a deal that you may not have access to. So I think that this actually bridges in with another interesting topic. We got a question from Joan in Tennessee about micro offerings, and there is no micro offering exemption, so that term is all relative. Sometimes we hear people talk about micro offerings, and what they mean is something under $100,000, which, while a large amount of money, is relative in the capital raising world, a small check size. Talk to me a little bit about recommendations you have for founders looking for small dollars. Grace, you were highlighting the potential for crowdfunding earlier. Curious if you have any recommendations for founders who are looking for a relatively small amount before they would be approaching more of an angel group like yours, Eli, or a fund, Elizabeth.
I would say, there's crowdfunding platforms, Kickstarter, everybody knows about Kickstarter, you don't take an equity stake with those. And so if you're looking at a crowdfunding platform from a Republic or a WeFunder standpoint, the investors can take equity, but there is some cost associated with that on the founder side. And so that can be a barrier because there's some upfront costs that can be a pretty big barrier for some entrepreneurs, especially when you're looking for a little bit of capital, because there's kind of a base layer there. But another great funding opportunity is through Kiva Loans. If you are familiar with the Kiva Loan platform, that's a crowdfunding loan platform, and a lot of times there are organizations like Ruralisk and others in other areas that will actually match. So you can crowdfund a certain portion of your loan, and then another organization will match those dollars. But again, you're not getting an equity stake, and those are 0% interest loans. But those that are lending the money from a crowdfunding standpoint are not getting any of that money back. So you're just kind of doing it out of the kindness of your heart to support entrepreneurs, which is absolutely fantastic. But I would, from an SEC regulation standpoint, I would love to look at more opportunities for those that are giving the funds, either loaning them or getting equity back, for them to be a way for there to be reciprocated without having the barriers of a platform like a Republic. That barrier's there because they've gone through the hoops that they need to make it where they can take on that crowdfunding equity stake. So those are my recommendations, but would love to hear from Eli and Elizabeth.
I would say, to the extent that you can, try to get as much non-dilutive capital, up to that $50,000 to $100,000 range as you can. Look at federal programs, state programs, local programs that might be able to give you grants. I recall Max yesterday saying that she just went on a business plan competition circuit, and raised a lot of non-dilutive capital because she couldn't coalesce that friends and family. And if you are going to take on friends and family, please make sure that you put all of that in writing, and make sure that cap table looks really clean, and you have to have that hard conversation with your aunt and your uncle and say, this is the investment and this is how you're going to get it back. And then you may not be carried forth in future rounds, right? So you want to make sure and have that honest discussion with friends and family, because once that starts to show up where you see a lot of the same last names on the cap table in those later rounds, that starts to raise more red flags for later stage investors.
And I think the last thing I would add to this is, ironically, even though I'm the VC of the group, we probably write the smallest check. We write 25K checks, and there are a number of VCs these days that are writing really small angel-like checks. And if you're trying to get up to, let's say, 100K, they can help you raise, from other angels here and there, 5K, 10K. It's actually really interesting. A lot of people think to be an angel investor or a fund, you need to be writing these large checks. But I'm seeing a lot of angels in Silicon Valley writing $1,000 checks. Like, that's a very common thing these days. And it's actually just a lot more accessible for people to get into angel investing as well. So the small dollars are definitely out there. It's just more about, I think, pitching anybody and everybody.
Well, and I think, Elizabeth, to that point, those are people who are recognizing that it's about making a lot of smaller plays so that you can have that diversified portfolio. Because as you mentioned about that $5,000 early investment that might one day turn into $25 million, that is the rare find. And so it's important that you really do balance out your portfolio. I think that's the perfect note to end on, because it circles right back to the title of today's panel. Before we move into voting to prioritize submissions, I want to thank each of you for spending time with us today and bringing the different perspectives that each of you have on different areas of the market to bear as we talk about these important topics. So Eli, Elizabeth, and Grace, thank you very much. This was an informative and wonderful discussion with you today. One of the hallmarks of the forum for our participants is that you have the opportunity to influence capital raising policy. So the polls that you are seeing here give you a chance to weigh in and share with us, what are you thinking about in terms of the most impactful policy areas that Congress and the Commission should be considering? The poll that you see is showing feedback that was submitted by you in advance, as well as during today's event, in which our team is consolidated and presented in a format that hopefully makes it very easy and accessible for you to engage. As a reminder from yesterday, for those who are new, based upon your feedback from prior years, we changed the recommendations process from an open floor where we heard voices one at a time to something that is more inclusive and equitable, as well as efficient with your time, where you get a chance to submit things in advance and we avoid the bandwagon or halo effects. So using the polling module on the right, we would love for you to rank your top 5 recommendations, with 1 being the most important. The topics will change each day based upon the focus of the discussion. So join us again tomorrow as well as Thursday for the final 2 days to vote on different topics. Before we switch into pure voting mode, as well as closing remarks from Julie Zellman Davis on our team, I want to flag that the poll will remain open after the live video stream wraps for an additional 30 minutes so that you have ample time to submit your recommendations. The final policy recommendations will be sent in a report to Congress later this summer. And as a registered attendee, you will automatically receive an emailed copy. Let's get started with voting. I look forward to seeing you tomorrow. And thank you for choosing to spend time with us today focused on capital raising policy. Bye-bye.
Hi, I'm Julie Zellman Davis from the SEC Small Business Advocacy Team. Thank you for spending time with us today focused on policy affecting early stage investors. I want to give a special thanks to our panelists, Grace, Eli, and Elizabeth, for sharing their valuable insights with us. Join us tomorrow for a discussion with Samir Kaji of Allocate, Gayla Jennings O'Byrne of Walkstar Fund, and Commissioner Mike Pichek from the North American Securities Administrator Association about diversity among important capital allocators, emerging and smaller fund managers.
Voting will stay open for another 30 minutes, so please take your time ranking the recommendations. Thank you. Recommendations are now closed. Thank you for joining us.